Hello everybody. So I got an ambitious video today, the Q1 recap, talking about the call, talking about all of the nuggets that I think are important to discuss, and also talking about some attempt at valuation now that we have the long-term guidance, some attempt at figuring out what this stock could be worth, perhaps in 2028, perhaps in 2030. So let's get started. Point number one that I want to talk about is we are definitely now in a post-GLP-1 revenue growth trajectory. This is confirmed to me because if you look, we grew to 586 million. We may have slightly of a flattish quarter in Q2, but when I look at the trajectory, that's 3 quarters in a row where now we've had an inflection point in the growth. This company is growing faster than it used to the entire time I've been covering it on the channel. This is now the 3rd quarter in a row, and the stock, of course, is slightly, ever so slightly down in after hours, and the reason why it's so slightly down in after hours is because Yemi said this sentence: we expect a one-time quarter-over-quarter drop in revenue in Q2 due to customers leaving the platform as compounded GLP-1s are phased out. But when are those compounded GLP-1s being phased out? Mid-May, so probably within the next few days. So this will be a one-time thing, and Yemi said that he is confident it will be a one-time thing. Yemi is the CFO, of course, if you follow this stock, you know. But, Hims has a history of overperforming. So I'm not even going to expect that. I mean, sure, that's what they say. Do we really expect that? I don't know. But I think that's what spooked the market. Is the fact that he said we expect a one-time revenue drop quarter over quarter as customers are being phased out. I still think a lot of them are going to move to the oral solutions. The CEO talked about, the great deal that the oral solution is less than $70. You can get an oral solution. And so you can transition from a compounded GLP-1 to that oral solution. There's liraglutide. And there is, of course, the branded Wegovy at $600. That's a little steep for people who are used to paying $200. But if there's no alternative, my guess is that many of them will just pay up the price rather than take the weight again and gain weight again, especially these drugs. I've been working on them. These drugs are miraculous. They're the blockbuster drug of the 2020s. So that was point number one. We are now in a post-GLP-1 growth trajectory. We have a company that's growing faster. So like I said, the reaction, that was my point number two. I got ahead of myself. That reaction is likely due to the one-time quarter-over-quarter revenue drop that is expected in Q2. That was discussed by Yemi on the call. Point number 3 of this call is the amazing guidance. First of all, they emphasize on the call multiple times it's at least 6.5 billion in revenue in 2020 in 2030, and at least 1.3 billion of adjusted EBITDA in 2030. Now, the reason why I say, will we achieve this in 2028? The reason why I say that is, let me give you a little flashback on the channel. This video was more than 2 years ago, 2 years and a half ago, actually. And 2 years and a half ago, I was discussing my excitement about the stock potentially being a 2.7x times potential in 4 years. Well, we're past that now compared to when that video was published. And my excitement about them possibly achieving $1.2 billion in revenue for a full year of 2025. And the joke is on me for believing their guidance back then. The joke is on me for believing their guidance back then, because now we are, 1 quarter in full year 2025, fiscal year 2025. We are 1 quarter in. And 1 quarter in, this is the guidance that they're giving us. They're telling us we're going to do between 2.3 and 2.4 billion. So 2 years and a half ago, they had guided 1.5 billion for the current year that we're in, and the current year that we're in, they're saying 2.4 billion, so there's already 2x of a difference. They already achieved twice what they said they would have achieved, which is quite outstanding, and they're likely going to up that number. I think they're going to up that number. The reason why they didn't move the revenue number up for FY 2025 is because they expect a drop quarter over quarter. But if the drop in GLP-1 in Q2 is not as bad as they've said on the call and as they've prepared the market, I think they will update that number to the upside. So anyways, what do we do of this 2030 guidance, and what do we do of the fact that they've heavily sandbagged before and that they've achieved really that guidance more than a year and a half early? So the way I'm going to treat that is I'm going to say you're not going to get there in 2030. I'm going to say you're going to get there in 2028. And backing out those numbers, looking at revenue growth, what would be the revenue growth, right? So that would, if we reach 6.5 billion by year end 2028, that would be a 53% CAGR of revenue growth over the next, few years, the next 4 years. Now, if we were to achieve that in 2030, that would be 29% average annual return compounded over the next 4 to 5 years. So this is important because in my evaluation, I'm going to reuse those numbers. So let me reuse the number of 54% compound average growth rate CAGR for the next 3 years. So there's 2 ways to really value this. The first way that I'm going to use to value this is thinking that really in 2028, by year end 2028, or February, and we'd find this out, of course, February 2029, thinking that at that point, they will have grown their revenue, their sales, they will have grown them by 54% each year for the next 3 full years. And I'm going to assume that the price to sell remains the same. This is kind of the dumbest back of a napkin math you can make. Very, very easy stuff, assuming the depressed price to sales that HIMSS currently has, assuming that price to sales stays just as depressed, fast forwarding in 2029, and if the price to sales stays the same, well, then the return of the growth rate of the sales, the growth rates of the sales return is also the return of the stock. So doing that very simple calculation, we have a $40 stock right now, times 1.54, times 1.54, times 1.54, we get a $146 stock by end of year 2028. So that would be a 3.65 times your money. If you fast forward that actually to say 2029, FY 2029, and you find out in say February of 2030, you actually get a 225, right? So this could easily be 4 times your money just using that methodology of price to sales by 2028, 2029, maybe 2030, although I think 2030 is way too late. I think they're going to achieve that early on. Now, what's another very simple way we could predict what the price is going to be? Well, let's talk about EBITDA multiple. They've guided an EBITDA of at least to 1.3 billion in 2030 or in 2028 or in 2029. They've guided that EBITDA of 1.3 billion. So to estimate what price could be, we need to know that, first of all, current HIMSS market cap is 9 billion, right? That's the current market cap. And of course, what is HIMSS on a price to EBITDA basis? What are they going to be traded at? So let's assume they're traded at Walgreens valuation, where it was now being acquired. But anyways, I just reuse that Walgreens valuation. 30x EBITDA is what Walgreens was trading at before a takeover. So if we do a 30x times 1.3 billion, that means that the HIMSS market cap would be 39 billion, somewhere around 2028, 2029. Now, and surprisingly, T-Doc's price to EBITDA, Teladoc, which is, I mean, it's very tough for me to find a company to compare HIMSS to, but I'm using Teladoc just because they do some telehealth, and Walgreens was a pharmacy, so I gotta use something in the middle. How about Netflix? What if I use Netflix's price to EBITDA? Although it's very unfair to use Netflix because Netflix grows much slower than a HIMSS. So they are 45 times EBITDA. So if you assume that HIMSS in 2029 is going to be trading at 45 times EBITDA, that means that the HIMSS market cap in 2029 or late 2028 or early 2030, that market cap would be 58.5 billion, up from a market cap of 9 billion. So depending on the price to EBITDA multiple you want to assign to HIMSS in 2029, we could have a stock that is worth between 39 billion and 58 billion. That would be between 4.3 and 6.5 times your money. This is quite outstanding. This would be an amazing return, and this is why I love the long-term guidance that we got. Now, moving on to evaluation and moving on to me updating my valuation and my valuation spreadsheet, and of course my favorite metric, which is enterprise value over gross profit over revenue growth. The big question whenever you calculate a new valuation on this is figuring out what the growth rate is going to be. I'm going to use 65% because even though they guided between 56 and 63% for FY 2025, remember that I have to lag these numbers by 1 quarter. Because forward revenue growth next 12 months is the 3 final quarters of 2025 plus the first quarter of 2026. So that's why I'm comfortable using 65%. When I input everything in the spreadsheet, all of the new numbers and the new stock price, because the stock is down 4%, what am I getting? I'm getting a stock that is still trading under a 0.10. This stock is at a 0.09. The cheapness persists. It is persistently cheap. It's been cheap for 3 years. Like, is it always gonna be cheap? Is this stock gonna rise its way to the top, being cheap the whole time? This stock has not benefited from much multiple expansion at all. There hasn't been any multiple expansion on this stock. It keeps being dismissed and being dismissed and being dismissed, and that's why I was happy to add. The last few weeks we were adding under $30. I was happy to add to my position under $30 because the valuation really hasn't changed, right? Buying this stock at $6-7 3 years ago or buying it at $30 today, that's roughly the same because the company has grown by the similar amount to what the stock price has grown. This company has grown in line with the stock price. The multiples, the ratios have not changed that much. This stock is still dirt cheap. This is why it's a channel favorite. But it's also a very high quality company now. So now this stock is both high quality and dirt cheap. Anyways, moving on to operational efficiency. So I have multiple things to say about that. FUD dies again, right? And if you follow this stock for a while, a year and a half ago, people were saying, oh, you don't understand, when the marketing goes away, HIMSS is going to disappear. HIMSS is all about the marketing. It's a marketing machine. And of course, this is the death of this narrative, right? Because if you look at how they've managed their expenses between Q1 24 and Q1 25, it's pretty darn outstanding. They've achieved the best growth in the history of the company. Let me show you again the past 4 quarters and the inflection point that happened 3 quarters ago. And they did all of that. The growth accelerated while decreasing your operating expenses from 79% to 63% of revenue. This is pretty darn impressive. Very impressive. And of course, when you increase revenue a lot while decreasing expenses nicely, what do you get? You get operating leverage kicking in. You get adjusted EBITDA kicking in. Note that they did a whopping 16% adjusted EBITDA in Q1 of this year. Now, in my spreadsheet, I'm still using 14%. Because it's what they guided, is the higher end of their guidance. But really, I should use perhaps higher than that. I should put 15 or 16% in there, and then the stock would look even better on a rule of 40. It would be a nice 80 rule of 40 if I used the latest adjusted EBITDA that they did. So it's outstanding. Operating leverage is kicking in. Operating expenses are going down. Revenue is growing faster than before. The revenue growth is accelerating. What more could I ask for, quite frankly? Moving on, subscribers. So the subscribers are still growing very nicely, just under 40%, 38%. So we see some large numbers kicking in. But that's not that big of an issue. Well, first of all, I'm such a growth snob. How could I complain that the subscribers are only growing 38% year over year? This is absolutely outstanding. That means we're getting more customers, but more importantly, we're getting more customers and we're getting them to spend more. This is the big deal. And what you see is that the average spend per subscribers grows faster than the total subscriber count. So people are we're getting more subscribers, and they are also spending more money. More subscribers, spending more money. This is a sign of two things. The more minor thing, I think, is a sign of cross-selling. We have a lot of cross-selling going on. That's point number one. And then point number two, the average basket is up due to the GLP-1s. And so I would argue that this increase in the average spend per subscriber is both the GLP-1s and the cross-selling. Probably a little more of the GLP-1s than the cross-selling, but probably some cross-selling in there too. Speaking of cross-selling, of course, we need to talk about personalized solutions. Of course, personalization is great because it makes the customer stickier. If you have a personalized pill with HIMSS, you're less likely to go use Row or whatever. But also you can charge more for personalization. And of course, HIMSS has been on a quest to getting customers on personalized medication. One patient, one med, one-to-one marketing. And it makes a lot of sense fundamentally why, I don't know, say 500 milligram metformin or 1,000 milligram metformin. That's all you can get. You get 1,000 milligrams or 500 milligrams. Like, what if you are a weight that requires 600 milligrams, right? You can't do that in a non-personalized solution. You can do that in a personalized solution. Personalized solutions make a lot of sense. They decrease side effects. You get just the right pill for the right for your right weight, your right person. Non-personalized drugs is really an artifact of mass market, and the fact that this industry, pharma, is an industry from the 20th century. It's an industry of standardization. Anyways, it makes a lot of sense to move to personalized solution. Look at the growth of people on personalized solution, 136% year over year. So they've increased the share of their customers who are on personalized medication by 136%. They're evolving the mix of their customers from a quality customer to a very high quality customer who is very much less likely to switch because now they have a personalized solution. I find that outstanding. Moving on to Capex. So there's a few things to discuss about Capex. So of course they discussed Phoenix. They rented some new building and they're moving forward. They're automated facilities, and so 700,000 square foot is a new building they rented. They're happy about that. Their peptide facility is ramping up. There's a lot of opportunities with peptides, of course, manufacturing the compounded GLP-1s that are not going away, although this will be rare. There will be fewer people, but the CEO talks about how indeed peptides are going to be a big part of the story at HIMSS, and there's many other areas of peptides that you can explore, many other types of peptides that you can sell. And they talked about the Trybe integration going well, and they are redesigning Trybe in order to make it ramp, especially on the back end. Let's talk about Trybe for a second. Trybe is a big deal. Why is Trybe a big deal? It's an at-home test kit, right? HIMSS will, you'll have your consult with your doctor, or maybe not even that. Maybe HIMSS will start by sending you the Trybe, and then it's called a lancet. You place it on your finger. You click on the little red button here, and a few drops of blood will drop. You close the vial, right? You seal the vial. You put it in an envelope. You ship it back. And then HIMSS does the lab testing. HIMSS does the lab testing over there. And then you got your lab results, you got your data. And once you get your data, not only can you see a provider and see whether your data says, qualifies you for such and such medication, but also you can track your data over time. And so this should be huge. For example, this could help, of course, prescribing compounded GLPs. That's one aspect. But this is huge because this is going to help HIMSS move into what I call the medium health problems. Not the easy stuff like ED or hair loss, but the more medium stuff that requires a pre-check of your blood before prescribing you something. The biggest of which, in the case of HIMSS, the ones that they're in a hurry to offer, is HRT, hormone replacement therapy, HRT prescription. This is menopause and this is testosterone. They started with menopause, probably because they didn't have Trybe and they couldn't start with testosterone just yet. But once they have Trybe, they're going to be able to start with testosterone. And the most legacy cohort of men on the platform is the ED pills, right? This company got started a lot with sexual health, right? Many men on the platform are going to be very interested in HRT prescriptions. So many men on the platforms need it, may already get it from one of these, shady looking strip malls, and you have the Loti store and all that stuff. I remember in the early days of the channel I was covering that as a key avenue for growth for him. So that was pre GLP-1 days. They have not given up HRT. They still plan on rolling out HRT because that is the next stage of sexual health, is rolling out HRT. And if you live in the US, these testosterone replacement therapies are extremely popular, and a lot of men, I think, are going to be compelled by the HIMSS offer. And so if they're compelled by the HIMSS offer, that is more cross-selling, that is a more expensive average basket. Furthermore, speaking of labs, Dudum commented on the call that we should probably do labs as often as we go to the dentist. And I could not agree more with that. The main reason why we do labs once a year is because that's how the insurance companies are set up. It's a yearly thing. But we probably should track our labs much more often. And I think this means better tracking, better data, better everything. It's really the insurance companies who dictated the yearly lab because it coincides with your yearly physical, but that makes very little sense. You should probably track yourself as often as you can. 3 to 4 times a year is probably a good thing. So I could see HIMSS, and this is something that I guess I'm the only one talking about. This is based on LifeMD, right? Because LifeMD does that too, so they follow each other. But I could see HIMSS have something like a monthly plan. Why wouldn't HIMSS have a monthly plan? $29 a month for $29 a month. So, essentially a Netflix subscription at this point. You get your yearly physical, and you get your lab tests, and you get the app, and you get the follow-ups if you have any issue. Why couldn't HIMSS have that, right? I could totally see a monthly plan that includes, say, 4 times a year Trybe testing where you get your labs and it's all in the data, and then your doctor on the HIMSS platform can track your medications and can see you for your yearly physical. And maybe your physical should not be done yearly. Maybe we should do physicals way more often, especially if you look at, say, some of the alarming rates, actually, of issues that people get into in their 30s. There's actually been a big rise of that. So I fundamentally believe in that, and that opens longevity treatment potentially, and all sorts of treatments that could happen for HIMSS. Moving on, and this was my favorite part of the call, which is the HIMSS CEO on insurance. Stunning take. Yeah, I believe I was hearing myself. I could not believe. This was, I think, a mic drop moment response to the analyst. I loved that part of the call. Go to the call, listen to that part of the call. That was so great. Analyst asked, do you plan to use insurance at some point? Because, I've always said on this channel, a big competitive advantage of HIMSS is that they don't use insurance. They don't have that complexity, and thus they can write a transparent pricing. It's $49 a month for your ED pill. It's transparent. The customer is not left wondering, how much is the office visit gonna cost? The customer is not left wondering, am I going to be ping-ponged to a specialist, right? Is the doctor gonna be, is my office visit doctor, is my MD that I see that day gonna be in the mood to treat me? If they're not in the mood to treat me, they send me to a specialist. Oh, it's really something you should deal with a specialist, which is a very common thing in healthcare, especially if you come for topics like sexual health, for example, and then they send you to the urologist. And then it's a 3 months or 4 months process. And of course, the urologist is not covered by insurance. It's a specialist. It's a $400 visit. The whole point where people are going with HIMSS is because it's cheaper than insurance. It's much cheaper than insurance. That's the reason why they're going with it. And I'm paraphrasing Dudum here, but this is essentially what he said. He said this is the last thing on his list of priorities. He's totally not thinking about it at all. It's just being polite, right? He said reimbursement is hell. He didn't say it like that, but that's what I understood. He said most Americans are effectively on high deductible health plans, which may not bear the name high deductible, but when you look at the fine print, it's technically a high deductible plan. It just doesn't have the name. And the insurance for most Americans often kicks in after they spend a few $1,000. He said $3,000. And if you want to get $1 of reimbursement beyond that yearly physical and beyond that $3,000 of cash pay period, right, of cash pay amount, you gotta already spend $3,000, not to mention the issues with the paperwork, the bloated system. And so the argument that Dudum is saying is that we're essentially already in a cash pay system. It's just that folks don't realize it. We're essentially in a cash pay system. Folks don't realize it. And I think that ramps up very, very well internationally as well. That is going to ramp up very well internationally as well. Because, for example, I still follow French news, and I see over there like how every 6 months they try to find a new fee, a new thing to add to the supposedly free healthcare system, to the point that you realize if you are like in a highest tier of income, well, you don't have any such thing as free healthcare. Anyways, the point is, I'm sure it's the same in the UK. I'm sure it's the same in Canada and so many countries where they just add on and tack on things, even in supposedly free healthcare system. So what Dudum said is so great. It's like we're already in a cash pay system. It's just that folks don't realize it. And he also said, we can provide so much of the everyday healthcare for less than the deductible amount. And I've said that many times before. Sure enough, right, 3,000, that's why, that's more than 200, right? About 250, right? 250 roughly a month, 250 a month that you could spend on HIMSS. That's literally 5 HIMSS pills. That's like 5 different products from HIMSS that you could spend, and you would still be in cash pay under a traditional insurance system. It is significantly cheaper. And I love the last thing that Dudum said. He said, we really have a catastrophic healthcare system, i.e. the healthcare system is not designed for everyday healthcare. It's designed for the catastrophe. It's designed for the cancer. It's designed for the unexpected broken leg. It's not necessarily designed for the everyday healthcare. I love that quote that he talks about. I'm going to reuse that. That's really, really good. HIMSS and hers for your everyday health. I could totally see this be a motto, for example, for him. That was a huge mic drop. I loved that response. Listen to the tone when he gave that response. He was very passionate about this. Very, very passionate. You could see it was his mission, and I love that very much. Go to the call, listen to that. I think it's a great part of the call. Final nuggets. Final nuggets. Point number 9. HIMSS plans to go international, but we have no details. They mentioned some success they've had in the UK several times, and they mentioned that they're going to go international, but very few detail was given. So I love this, of course. If they go international, that's a logical step. If you're out of the reimbursement system, all of a sudden you can go international, can't you, right? I mean, you have to comply with regulations and all of that, but you don't have to comply with reimbursement, and reimbursement is really the bulk of the cost of healthcare. So the moment you don't comply with that, you can have some success internationally. I love that very much. Also, imagine, and this is something, studying LifeMD is helpful too. LifeMD, if you study LifeMD, you may know that a lot of people actually buy visits on LifeMD. They buy office doctor visit, because in their country, they gotta wait 3 months to go have an office visit with a doctor. On LifeMD, office visit is 36 to 48 hours. You get an office visit, and so I see a big business for HIMSS if they do office visits. Well, why don't you have an office visit, right? Like why don't you get your HIMSS plan, and you may be in a country that has socialized healthcare, and so of course it's free, but it takes you 2 months or 3 months to find a doctor if you're lucky and you ever find one, right? If you ever lived in a country with socialized healthcare, you know what I'm talking about, right? If you moved to a town that doesn't have a lot of doctors, you got to call all of the doctors of a town, and they all tell you, oh, Dr. XYZ does not take 2 new patients. Sorry. Oh, Dr. XYZ does not take 2 patients. And then you find a doctor who takes new patients, but you got to wait 5 months to see that doctor. LifeMD does business selling doctor visits like internationally across country lines of people who are just gonna see a doctor in the US because it's quicker. Anyways, I think this could be a major opportunity for him to go international. And you could simply export doctor visits without exporting the meds, right? They could also do like urgent care. There are so many things they can do. This is endless. CEO now clearly compares HIMSS to Netflix. This is a clear comparison. He used that reference multiple times in the call, comparing it to Netflix. The CEO is emphasizing the AI narrative. The AI narrative is becoming stronger and stronger. I really don't understand why this stock is not more expensive. Again, HRT and menopause are the next big thing. I've said that. Longevity offering. I love that. The CEO talked about possible longevity offering and possible peptide-based offering. He mentioned pain management. He mentioned dermatology. There's a lot of things that can be done with peptides. Peptides are part of protein science. Peptides are the building blocks of proteins, and they are the current revolution. They're one of the current revolutions of medicines. We have genomics, and we have protein-based stuff, including peptides. We're finding out more and more stuff about peptides, and peptides have this advantage that they're fairly easy to manufacture. And I don't see a reason why HIMSS could not be able to just roll out a peptide offering, unpatented peptide, or peptides that are not patentable, and start selling them. This is a big part of medicine. So again, no, we're not wasting growth. There's a lot of opportunities for growth going forward. And the last thing the CEO mentioned on the call, which is noteworthy, is the wearable devices and the tracking, and including these wearable devices and these tracking possibly in the system. The last thing I mentioned that I remember now that I didn't put in the slide is the sexual health. So ED pills, they are working on moving from a one-time use ED pill to trying to get men under monthly prescriptions, a monthly pill that you take to just get rid of ED altogether and not pop a pill every time. I assume in their model, they figured out that men just buy hard mints, they buy it once, and then they just cancel the subscription because the hard mints last them, I don't know, a year or 2 years or something like that. And so they're trying to transition a lot of the men's health ED from one-time use pills to pills that actually address the underlying cause. And so to do that, they pair it with, say, heart health, they pair it with hair loss to turn it into a subscription. So that's the one thing I wanted to mention that I didn't mention in there. Anyways, this, as always, this was not investment advice. This is not financial advice. This is just entertainment, hoping you were entertained. Please like, please subscribe, follow me on X, follow me on Patreon. Thank you for watching, and have a wonderful, wonderful day.